some really interesting trends to note there. One of the things that we track here at Optimal Blue is something called the primary secondary spread. And that is meant to be the difference between the retail rate, or what we see locked in the industry. OBMMI is a great index that captures that. And the secondary rate, or where we see mortgage-backed securities trade in that secondary market. Historically, you usually see that spread somewhere in that 1.25 range. And what we saw at the beginning of the year when OBMMI was closer to 7.125 was that spread was about 90 basis points. So as rates have gone down, and they're in that 6 5/8 category that Brennan called out, we're actually closer to 110 basis points. So we're getting back closer to a world where we're seeing a higher profitability on a loan level basis for lenders, but it's still nowhere near historic. Like when I was, you go back 5 or 10 years ago, everybody grounded themselves to that 125 primary secondary spread. And then in COVID, you saw it blow out. It was almost 2 points at different moments in time, and then went down into like the 70s, 80s, 90s, and then now back up to 110 as rates go down. That like spread effectively is like the slack that lenders have from a capacity standpoint. So as rates go down, you see that spread widen because they may not have enough processors to actually get through the stack of applications that they have. And then you see the inverse in moments when rates are going up, they have more excess capacity. They have folks sitting around who may not be doing as much as they can, so they can get more aggressive on a pricing standpoint. So it's a really interesting kind of like dichotomy there between rates going up and down and that spread contracting or widening out.